Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, looking at the implied, with the yellow being the implied volatility mean, and the blue being the 30-day historical volatility, you see just how amazing the volatility became in October, November, and just how that has fallen off rather precipitously over the course of the last few months here. And it's really, which this served as the catalyst behind kind of putting this webinar together. All right, well, what are we going to do now when this begins to happen? I mean, most of us do enjoy trading in a high volatility environment. As traders, for most of us, that's our juice. As investors, it's not so nice. Seeing your portfolio rise or fall by 5 or 6 or 7% in a day carries with it, a lot of angst. Moving forward here, so this is what we've seen in the Aussie. And again, I use that first and foremost because that really has embodied amongst the currency sets, the risk appetite, risk averse dynamic. And I'll show you that chart, what that rise in implied volatility and what that decline in implied volatility has meant. Looking at the British pound here in terms of what that's done as well. Again, we're seeing amazing historical volatility. And what's interesting to note is that as the historical volatility is rising, it doesn't mean that implieds are catching up, because when they're pricing in the underlying metrics behind, okay, what's the implied volatility of this market? Again, it's the perception of the future standard deviation. Okay, so you can see wide gaps. So you can see the relation between the two expand apart and also come back again. So obviously the two come back in line in December when things settled down, which was a surprise to me actually. I was surprised December was as calm and tranquil as it was. And then we begin to see that kick up again. Historical volatility begins to break up above implied, and really since then this has dissipated rather dramatically. And for those that have been really more on the premium selling side, they've done very, very well. I know from just glancing through some of the numbers, those strategies which in October of last year just got crushed, i.e. selling naked calls, selling naked puts, have had a pretty good comeback this year. But again, like with every investment out there, it's about understanding the risk and being comfortable with the risk that you take on. There's a lot of other ways you can come in and take on that short gamma exposure without necessarily having to keep that leg unhedged or open or fenced off. All right, looking at the Canadian dollar, we're talking about again a very capricious market, if you will. Very binary in terms of how it can rally and sell off. Again, historical volatility or realized volatility went substantially past where the implied levels ever got, and then again a declining market as well. Just looking at the two, and as we move forward here, we're looking at the implied volatility sitting below about 14% right now, and so we'll just keep that in mind as we move forward through the presentation. Euro. Probably no. This is the most luminous or followed currency cross in the world. The relationship between the euro and the U.S. dollar, and in the way that this is priced in terms of the U.S. dollar is priced in euros, and so how many that gets you. Again, very active fall between October and November, September, October, November time frame, and as that dissipated. And again, we're looking here at in terms of what's priced here is the 30-day historical volatility versus 30-day implied volatility. And that, if we even broke it down to further, we'd even see higher spikes in the realized vol, especially in those days of October when we had the Dow range between 500 and 800 points, even down 1,000 points, I think, at one point in time, or 900 points at one point in time during the day. The Swiss franc, not quite as dynamic as some of the other currencies. There's some variables at play there that stretch beyond this presentation. Steve alluded to them a little bit earlier on. They're different standard in terms of how they're backed, but nonetheless, though, we still see that obviously more towards the lower end of its range as well. Looking at the yen, the yen being commonly associated with the inverse of the markets in many particular instances. The rally that it put on in October and just the kind of range that it had. We actually saw a nice move in the yen last Wednesday, up over 4 big figures at one point in time, and just the yen's actually a pretty important spot itself here. So along with watching, like I talked about earlier, how the Nikkei opens up and how how the Australian S&P opens up in a few hours from now. We'll also see sort of how the yen reacts to this intel news with equity markets higher across the board. We're looking at equity markets at about a 1.2% gap up tomorrow morning. That's a pretty material move right there, especially like looking at this key downward trend line in the S&P and what that represents, and also looking at the yen try and go back and retest a key level as well, how that proceeds going forward. God, there's so much to talk about here today, guys. I'm so excited. I'm so passionate about this. I can't wait to really just go for it. All right, so popular strategies used in the recent decline of volatility. Saw a lot of people playing calendar spreads out there, doing particularly well with that volatility skew being as positive as it was, and then we had some collars out there, and then call spreads and put spreads. And so what is a collar? So looking at a collar, it's the process of owning the underlying and selling an out-of-the-money call to pay for a put. It's pretty vanilla strategy. Basically helps you mitigate some of the vega risk you have, or really neutralize the vega risk you have in underlying strategy. You can trade around an underlying, and it's based on a trading range. You think the market's going to trend up. Collar more or less takes on a very similar price dynamic to being just long a call spread, which we'll talk about in a little bit. But when you trade the stock market, you may be dealing with uptick or downtick rules, which may help you move around the position. If you're trading futures or forex, it's not an issue in terms of obviously you're just selling or buying. But that's kind of the first thing that we'll take a look at today, is look at some of these markets. Implementing a collar. Well, here's an example of that. We'll go long the Euro USD. Then we'll go long on ICE. We'll go long on ICE FX Euro put, and then we'll go short on ICE FX Euro call, or however many numbers you want to put on. So that's an example of that. In terms of a calendar spread, in this case, we'll look at selling an option of the same vehicle in 1 month while purchasing an option in more distant months. We'll sell a July, Euro EUI 71.5 call for 54 cents and buy an August EUI call for a 133. It's going to incur a 79-cent debit. That debit is something that the focus being that at the end of all that, we have a little modestly slightly bullish position. Or at the end of that time, if the euro is still in that range and that front month call expires worthless, at that point in time, the August call may be priced at $1.05, assuming you're at the money, maybe $1.02, kind of just talking out loud. And so there might be a little 25 cent profit in there based on that. Again, it's different from being naked calls, but the gamma shifts depend on the front month. If there's a ginormous, crush in volatility, depending how far out your calls are, that becomes a bigger risk, but you benefit from the time decay. There's some other variables there as well. A little bit about how that looks in this case here, looking at a Euro 139 calendar spread as this sets up and kind of where our break-evens are. There's 27 days to expiration here. And we see that our break-even sits around 136. On the upside, about 142 somewhere in there in terms of the underlying FX cross, with the max P&L sitting at the 139 even level if we park around there. Okay, call spreads. I talked about this a little bit earlier in terms of that's a simultaneous purchase and sale of a lower price call and a higher price call. Also, the owner of a bull call spread will buy the lower price call and sell a higher price call, incurring a debit to the account. Put spreads, again, we're talking about the simultaneous purchase and sale of a higher price put and lower price put. The owner of a bear put spread will buy the higher price put and then sell the lower price put to incur a debit. And again, this is just another strategy for neutralizing your Greeks and taking out that vega component in terms of the underlying volatility. So if you really want to focus on just market direction, and focus on playing that angle right there, and not being worried about what we call a vola cost, where the VIX goes from 30 to 25. This is going to go a long way to making that happen. All right, a little bit of my screen layout. I use a software called CQG. There's various software applications out there. This is one that I use to help put out my stuff, and that's where I find out my Greeks and determine how I'm going to put on a play in the market.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.